Now that we've covered the basics on structured strategies, let's look at the reasons we don't typically use them. The gist here is that investors just end up paying too much for the downside protection that is not often or rarely needed. Let's walk through the issues. The first one is simply that structured notes are not cheap. Fees can vary quite a bit, but 1% to 2% is pretty typical. The second is the constant tax impact. Unlike a buy and hold investor who can let their gains compound and only pays taxes when they decide to sell, a note holder doesn't get that choice. Every maturity date is a taxable event. While there is some ability to trade in structured notes, it's not a liquid market, and it's only at maturity that a note is worth what the terms detail. It's these last two, though, that are the real kicker. Return calculations for notes exclude dividends. In our example, we'll use the S&P 500, which has a dividend yield of about 2%. That may not sound like a lot, but giving up 2% of your return every year makes an enormous difference. Lastly, investors are simply overpaying for protection that isn't needed as often as they might think. Since 1986, there have been 111 quarters of positive returns to just 45 negative ones. We can see it even more clearly by comparing groupings of returns paired by color. For example, the two light blue bars compare how often the market was either up or down between 5 and 7.5%. In that case, there were an incredible 24 quarters to the positive compared to just 3 instances to the downside. That is the most extreme example, but it's also where those return caps start to come into play. For notes where there is a quarterly reset and some downside protection, the caps are likely somewhere between 3 and 6%, which means investors will miss out on any quarterly return that is above those levels. Adding the positive occurrences in the light blue, orange, and black bars totals 60 quarters, or nearly 40% of the time, when the investor would likely miss out on some upside. Investors often like the idea of participating in the stock market with downside protection, but the high fees, missing out on the dividend, and also frequently missing out on upside is just a lot to overcome from a performance standpoint. Let's pivot back now to structured equity ETFs. There are differences, but conceptually ETFs and notes are very similar. I do believe structured equity ETFs to be an improvement though. In fact, the ETF structure reduces or eliminates aspects of our first three issues. Unfortunately, they do nothing to change the two which are the real deal breakers. For those who are more visual, let's pull up one final graphic. This is the S&P 500 return over time with dividends, the black line, and without dividends, the gray line. We then compared those returns to 3 recently launched structured equity ETFs. We simulated how those ETFs would have done over the same time period using their recent terms. The 3 ETFs all had varying levels of protection and upside limits, but in the end, none of the 3 were close to keeping pace with the index figures. The ETF wrapper may be an improvement over the notes format, but as I mentioned before, it just doesn't solve the big underperformance issue. And to borrow a term from Shark Tank, for that reason, I'm out. As always, thank you for watching. If you have questions or would like to talk about your personal wealth management needs, please contact us at the number or email shown at the close of this video.